Welcome to the AB Study Partner. All right, today we're jumping into a classic tax law case that I think is just brilliant. It's got everything: a farmer, a flock of sheep, a whole lot of cash, and a tricky little question that even had the taxman scratching his head. So let's get into the case of the tax-free sheep. Okay, let me start by asking you a question. If someone hands you a pile of money and you pop it into your bank account, does that automatically mean it's your income, that you have to pay tax on it? I mean, it seems like a no-brainer, right? Money in, tax out. But as we're about to find out, it is not nearly that simple. So our story kicks off, as so many of these legal dramas do, with a will. But this isn't just any old will. This is a special, mutual will that really sets the stage for the whole mystery. Let's meet our cast of characters. Our main character is a farmer's wife. Now, in the eyes of the law, we just call her the taxpayer. She and her husband had built up their farm together, their joint estate. The land, the house, the livestock, the whole shebang. And they created this mutual will to figure out what would happen to it all when one of them passed away. Now, the will itself was pretty clever. It basically did two things at once. First, it made sure that whoever survived, in our case the taxpayer, could live comfortably. She got all the fruits and income from the estate for the rest of her life. But, and listen, this is the really crucial part, the actual ownership of the estate, the capital, that went to their children. They were the heirs. So her job was to enjoy the income, but also to protect the main estate for them. So for a good while, everything is going just as planned. But then something happens. An event that puts this whole arrangement under a microscope. It's time to talk about the big sheep sale. Okay, so fast forward a few years after her husband's death. The taxpayer decides it's time to sell a flock of sheep from the estate. Now, she's not doing this behind anyone's back. She gets her children's permission first. The sale goes through, and a big chunk of money lands directly in her hands. And right here, this is the detail that cracks the entire case wide open. So please pay close attention to this because it is so important. The number of sheep she sold was actually less than the number of sheep in the flock when she first inherited the right to use them. The flock had actually gotten smaller over time. Just tuck that little fact away, it's everything. So, of course, the tax authority, the South African Revenue Service, CIRS, they see this deal go down. They see a person receiving a whole lot of money. And from where they're sitting, the math is simple. Money received equals income, and income gets taxed. So they sent her a tax bill. But the big question is, was it really her income to begin with? To answer that, we have to get our heads around a key legal concept. It's a bit of a fancy-sounding word, but I promise the idea behind it is super simple. Let's break down this thing called a usufruct. A usufructuary is just the formal legal name for what our taxpayer was. Think about it like this. Say you have a usufruct over an apple orchard. That means you have the right to go in, pick all the apples, and sell them. Those apples are the fruits, and they're all yours. But you don't own the trees themselves. You can't just chop them down and sell the wood. Your job is to take care of the orchard for the actual owner. And that apple orchard analogy fits this situation perfectly. Let's put it side by side. The fruit that was hers, her income, was stuff like the wool from the sheep, maybe their milk, or any new lambs that made the flock bigger. That stuff was hers, totally fair game for tax. But the original flock of sheep, that was the capital. That was the apple trees. It belonged to the heirs, her children. Well, the taxpayer wasn't having it. She disagreed with CIRS, and this whole thing went all the way to court. All the arguments were laid out, and it was time for a judge to make the final call. Let's head to the legal showdown. And here it is, the knockout punch from the court. The judge ruled that even though she received the money, she never became entitled to it. And because she wasn't entitled to it, you can't include it in her gross income. An absolute mic drop moment and a huge win for the taxpayer. So what was the logic here? How did the court get to that decision? Well, it was actually beautiful in its simplicity. First, the court said, look, she was a usufructuary. She only had the right to use the flock. Second, and remember that critical fact, the flock had gotten smaller. That means there were no fruits, no surplus baby lambs for her to claim as income. In fact, the capital itself had shrunk. So third, all the money from the sale was just converting the heir's property from one thing, sheep, into another thing, cash. It wasn't her money at all. This case has become so famous in tax law because it perfectly spells out one of the most important principles you'll ever learn. And that's the massive difference between physically receiving money and actually being entitled to it. So here's the key difference, broken down. Received by just means the money is in your hands. You're holding it, maybe for somebody else, kind of like a courier holding a package. But entitled to means the money is legally, truly yours, for your own benefit. It has your name on it. And only when you are legally entitled to that money does it become part of your gross income. And that, my friends, gives us our golden rule. If you remember one thing from today, make it this. An amount received by a taxpayer on behalf of another person is not that taxpayer's gross income. Our farmer's wife was just holding that money on behalf of the true owners, her children. Now, this isn't just some dusty old story about sheep and wills. This principle is working all around us, every single day. Can you think of any other examples? Just think about people whose jobs involve handling other people's money.
Exactly. Think about it. An estate agent gets a massive deposit for a house sale. They've received it, but they're not entitled to it. It's held in trust for the seller. Or a lawyer who holds client funds in their account. Or even just a parent holding on to savings for their kid. In every single one of these cases, someone has received money, but they are just acting as an agent. The money isn't theirs, and therefore it's not part of their gross income. It's a simple rule, but with absolutely massive implications.